Hey guys, today we're going to be doing our weekly market update for the Phoenix metropolitan area. And again, I'm Chris Mincola with the Mincola Group over at West USA Realty. And we're going to show you where we're at right now, where we're headed, and what to expect or what's likely. Anything can change, but here's what's going on. There's a lot of bad information out there. There's a lot of clickbait. There's a lot of speculation. And we just got to, again, and I've done videos on this. If you check your emails, if you get our weekly email or go to our YouTube page or Facebook page and whatnot, and you can pull those down and where we're going to be on rates and everything here shortly in the next few months, and when the market should be popping back here. But where we are right now is very interesting, and if we look at what is going on, it actually makes a lot of sense in a lot of ways. So let's jump right in and see what's going on. So, right now we see that builders, because of the high interest rates, high inflation, obviously people, it's affected people's demand. And that's what happens when inflation goes up. The Fed waited too long, but they raised rates. And now they're doing what's called demand destruction. And in that means that, they're trying to slow down the market a little bit, slow down the price of everything, especially the core things that they can control. They can't control crops and the weather, for the crops. They can't control if a pipeline busts or an embargo. But what the Federal Reserve, whether you think that they're doing a great job or not, and whatever you think about the Fed, the way the economy currently works is they step in to control inflation. Now, they waited too long. It wasn't transitory, and it didn't peak a long time ago, as we know. And people are certainly feeling the brunt of inflation. There's no doubt about it. And, that also went into the housing sector. Prices went up. But now they're trying to combat the inflation with raising the rates, and they've been gradually raising the rates, this year. And we're looking at, builders doing, obviously they're going to slow down a little bit with the demand slowing down. Builders are saying they have a forced slowdown. This is from Realtor Mag, forced to slow down, and their construction and buyer demand plummets. Builders predict lower home starts through 2023. Now, keep in mind, right now, we've got this demand destruction, high inflation, everything costs more, and higher interest rates on top of that. Plus, prices were already up, and then what time of year is it? It's the slow season, guys. So it's kind of a perfect storm where it's all hitting at once, but there is light at the end of the tunnel. But just to kind of run through this info a little bit more, builders are pulling back on their production, which, hey, they gotta protect themselves. They don't want to end up with 2008. Now, keep in mind, 2008, we had way too much inventory. We had 3.8 million in inventory, and every year we've got about 1.7 million households being formed. You got about 100,000 homes being destroyed every year. And I talk more about this in other videos, but basically at any given time, from that 1.82 million what they say is active inventory, a lot of that's dirt and a lot of that's under contract. When they talk about some of these numbers about, oh, there's this much more inventory. So in a nutshell, basically we've got at any given time out of that 1.28 about 556 or 9,000 that are going to be under contract. And then out of that, you've got 779 that, you could actually move in at any given time. But again, that's your new inventory. You got 1.7 million households being formed every year. So some of this has definitely slowed things down. Some people are living with, their parents longer, or maybe they're renting a little bit longer. People are not selling their homes as fast or as soon as they might have, unless they had to move. If they could, if you can afford to buy right now, I tell people, look, even if you got to sell a home and you're not going to get as much for it, if you really need to sell right now, think of it like this: either the prices are low, which they definitely have gone down a little bit, but overall we had an anomaly year the last 1 or 2 years. So overall, everything is up still on the housing market by quite a bit. Everybody's got tons of equity. better buying practices and all that for loans. So we're not going to see those crash issues like we saw before. But there just isn't enough of that new inventory. There isn't enough of that new inventory coming in the market. So there's actually a shortage of homes overall, but people just aren't selling their home right now because if they don't have to. So that's a big portion of what's not happening, because they've got maybe a 3 or 4% interest rate, or even 5% interest rate. And they're just like, I don't have to move, so I'm not going to move right now. And then you've got the first time home buyers, and maybe you're like, whoa, I'm going to stay with mom a little bit longer, or we're going to rent a little bit longer, and so on. Just like with all the other products out there with high inflation, we're not going to buy that car right now, keep the car I got for a little bit longer, and all those sorts of things. And then we go into seasonal stuff, and everybody's, everything slows down during the holidays as far as the housing market's concerned. Typically, you definitely have serious buyers out there and all that. And that's just kind of how it goes seasonally. The big time is, the busy season is when everybody's getting ready to go back, getting out of school, want to buy a house, and then get back into school. They don't want to be moving their kids around and stuff, and dealing with different schools and friends and all that. Outside of that time frame, they want to do it while school's out. So but the funny thing is, with the shortage in demand, we also have this housing shortage. We do have this housing shortage. Even Lawrence Yun, chief economist of the National Association of Realtors, noted this and said, current annualized rate is 1.44 million new units, is lower than the historical average of 1.5 million. And again, we've got to maintain the historical average to at least try to accommodate the rising population, Young says. So again, crash, you had 3.8 million. Now you've got about 1.2, but a lot of that's already under contract. That's not move-in ready new inventory homes. When people do sell, they buy, so that's not necessarily new inventory. Some of the stuff that's kind of stagnating out there is also stuff that these iBuyers bought, which is a pretty good portion of the market. And now that stuff, they just have all these so we see the price reduction numbers up a little bit because they keep lowering their prices just to get out of those homes. And they've been sitting there for months because they way overpaid for them, which was part of what was helping to inflate the market a little bit, or a sense of inflating the market, even though some of those purchases, not all of them, but some of them didn't even register on the MLS, which means for an appraisal, you really can't use them. But in any event, that is raising, kind of inflating some of the numbers as far as price reductions, homes sitting longer, that extra inventory just sitting there because they way overpaid for it. And you have builders listing more homes on the MLS too, since, May, June up till now, because before they did, when the home was ready, it was gone or was already under contract while it was being built, or when it was dirt. So, they didn't have that problem before. In the last year or two, while things were moving so fast, they weren't putting their houses on the market on the MLS like they were prior to the anomaly years. So, and now they're going back to that. So mortgage rates punch through for a lot of people, up through about 7%. I know this just a couple of days ago, sitting in open house at Litchfield Park here locally, and another property up in Sun City that we have. They're both listed for 600,000. And with that, we did a scenario with our loan officer Andrew Fisher and my wife Cynthia, and we were talking about, in this video I posted it on our social media, and you may have gotten an email. If you want more information about it, let me know. But it was about 2-1 buy downs, which is really popular thing right now, because even with that scenario that we went through just a couple of days ago, the interest rate with 20% down was going to be 6.5%, with with good credit, obviously qualifying. But with the 2-1 buy down, the first year, just getting 2% in closing costs, which I'm going to talk about in a minute, from the seller, a buyer could get a 4.5% interest rate. Now that's a big difference for their first year in that home, especially if interest rates are expected to drop in 2023, which they are, probably by Q1, Q2-ish, right in there. Because remember, when we're in recession, when we're in a bad economy, like we are right now and heading, into through the holidays, by every indicator out there, we see the interest rates end up dropping, and I'll even show you that on a chart here in just a second. So, but the Fed, they waited too long, all this, but they're hiking interest rates. They're expected to hike interest rates through the end of the year. When those November numbers come out, and their December 14th meeting, those are really going to be the tells on where we are with inflation, and then that will be the indicator. And a lot of this is lagging as far as where we are. The question is, has the Fed gone too far already? Will they go too far by the end of the year? Will they raise the federal funds rate, as much? Because remember, federal funds rate isn't directly the mortgage rate that we're talking about, but it does affect how much it costs to borrow money. So then it indirectly affects the mortgage rates. It affects more like your credit card, your credit cards, your equity lines of credit, your credit cards and car loans, things like that. So we'll be watching this. We'll keep you up to date on the next couple of months. In November, I think we're going to start seeing a little bit of a shift, but definitely by that December 4th number, once those November numbers come in. So there's kind of that lag, okay? So because they're reporting on the month prior. So anyways, and I went into this in more detail in another video. You can check it out online, when will rates be below 5%. And we're figuring by the end of Q1-ish, give or take a month or two, right in there. And that's what Barry Habib and all the crystal ball gazers, so to speak, have to say. And they're usually right on the money, unless there's unforeseen events, but it's what's likely, right? It's what's likely. None of us have a crystal ball, but we have, as long as we keep printing money like crazy and do, for things like war in Ukraine, the Infrastructure Act that wasn't really about infrastructure and things like that, all the money that had to go out to for the pandemic and the COVID stuff, that was extra printing of money that went out. It's all inflation, all inflationary factors, right? So that's what we're combating now. It's like I say in the other video, it's like a fireman, an arsonist who turns into a fireman. Now he's trying to put the fire out. So nearly a third of income is getting gobbled up in a mortgage payment right now. When you take into consideration, the rise in prices, and then the mortgage, going up, as far as 30.2%. When we look at rather than 22.8% of a homeowner's income, we've got, we're at 30.2%. So, a lot of these are inflationary factors. Prices of homes gone up, interest rates have gone up, all that. I don't always agree with some of the numbers. They don't always match up with us locally, and some of the national stuff's kind of hokey too once in a while. But right now, and Zillow's got their own lawsuits and problems. But right now, for what's out there in the clickbait world, Zillow is saying, forecasting a flat values over the next 12 months. On a national level, home prices are about 20% higher than they would need to be for affordability to return to normal. Now, overall, homes are up about 18% across the nation. In the Phoenix area, this year over year, we're up about 28%. Okay, using round numbers. So yeah, depending on the area that you live in, your neighborhood and all that, and type of home and everything, we're looking at around 8, 6, 8, maybe 10%, depending on where you live in the valley, in the greater Phoenix area. So let's just say about 8% down. But if we're up still, went up 28, come down, if your home went up from 300 to 500,000 and it went down to 480 or 450, you're still up, right? You're with me here on the numbers. So some of this stuff is, clickbait hysteria, so that they can make money for you to buy the boots or the car next to the, clickbait on the ad. Not saying people aren't hurting out there. Inflation is ridiculous. Interest rates are crazy. A lot of this could have been avoided way back, earlier on with the Fed and with some of the current policies and stuff that we're having to deal with, but we are where we are. New listings are coming on the market gradually at a rate of 16%, according to this article from Inman, which is quoting Zillow. Slower than the same period in September of 2021, according to the report. The next several years appear to set up for affordability to be a major challenge for home buyers. So, they're still saying affordability is going to be an issue. But as I mentioned in another video I just did on when will we be at affordability and 5% and all that on interest rates, when we look at how much wages have risen, if you stayed at your job or if you switch from your job, going into 2023 numbers, where the numbers have been over the last year, we should see people kind of level out, even if they don't refinance or all that, which I don't know why you wouldn't. But if so if you're thinking ahead, again, you buy a home now, even, if you need to, and you can afford the payment, obviously. If you need to buy a home, go for it. And if you're thinking about waiting to sell and kind of time the market or waiting to buy to time the market, it's either one or the other. It's either the prices are going to be down and the demand is down, or the rates go down and then, the demand goes up, especially when we're talking about seasonally on top of that again, okay, going into the new year. So keep those things in mind. If you have to sell for a little less right now, but you're getting a deal on the purchase, you're getting closing costs, which are probably going to be the case to buy down the rate or do a 2-1 buy down. All those are things that you can kind of play around with and look at those different scenarios on, and then make a more educated decision rather than just I'll wait and try to time the market, which, usually you don't know you're in a recession. You don't know that these things are coming up. You don't know that all this is going to happen, until it does a lot of times, or, for most people, because they're just not paying that close of attention. So, home values, here it says home values would need to fall 24.7% nationally to return to the 22.8% norm of housing affordability. Okay. And it goes on to talk about different markets like Salt Lake City, Dallas, Las Vegas, that saw a dramatic rise in values, all of which are the furthest away from ideal affordability levels, all at least 37% higher. Okay. And Phoenix, Boise, a lot of these would be thrown in there also. So the other thing I wanted to show you was right now, new listings by day, month to date, okay, are the lowest that they've been. Okay. New listings coming on the market, lowest they've been since, going back to 2005. So, right now that number would be 4941. Last year was 6888. Year before was 7510. Before that, even before the pandemic, 6707. So we're super low on inventory, which is actually keeping us from going into over inventory, which would cause a problem. For the Phoenix area, we talked about nationally. I talked about where we kind of need to be, where we were in 2008. For Phoenix, we were at 56,000 when the crash happened. 2008, we were at 56,000. We're nowhere near that. We're, depending on the day, we're probably right around 19 to 20,000 on the MLS. We're under, and again, a lot of that is that iBuyer stuff. Some of it are the new homes that they weren't putting on the market before that have helped inflate that a little bit. So, and really new inventory that somebody isn't selling and then going out and buying another property in the same market is, that new home inventory that we're talking about. So, all right, guys. So the CMI, the Crawford Market Index, is why a lot of people like to get into this and learn on what the Crawford people here, they're the local gurus in the Phoenix area who give us all our stats with our multiple listing service and the MLS. So right now, the overall market index is at 97.6. Anything below 90 is a buyer's market. Anything above 110 is a seller's market. And anything in that middle range between that 90 and 110 means we're in a balanced market. So right now we are in balance, and the supply index is at 81.1. Okay. That's the highest we've seen in several years, since about 2014, for that supply index. That is making, a big difference as far as that goes, but we're still undersupplied. It's crazy. I know it's great. Sounds crazy. And then the demand index is at 79.2, 79.2. So that's why those numbers are super close together, because when they are the same or close to the same, that demand and supply, that means we are in a balanced market. And right now, voila, we are in a balanced market, balanced with a slight edge in most cities in the greater Phoenix area to the buyer. Okay. And looking at that real quick, the market index overall went down minus 6.8%, as far as the overall index, in the last month. The month before that, it went down 4.6%. So there's an acceleration there in getting it to the balance or buyer side. And if we take a look at individual cities, the only cities that are up at all are Gilbert, okay, and Buckeye, okay, which is a little twist there with Buckeye because they've been kind of in a negative for a while. But Gilbert's it's up, but it's up 1%. The cities where you still might have a little bit of better edge as a seller would be Fountain Hills, Paradise Valley, Scottsdale, and Cave Creek. You might have a little less coming to you in concessions, a little less negotiating with the seller in those four cities. So other than that, everything else is within balance or in a buyer's range. Even Buckeye, even though it went up, it's at the bottom of the barrel as far as sellers go. So that's at definitely in a buyer's market of 51.3. Same thing with Queen Creek, Maricopa City, Surprise, Avondale, Gilbert, overall, Peoria, Goodyear, Mesa, Tempe, and looking at Glendale, Phoenix, and Chandler. So there you go. Those are the major cities in our metropolitan area. So when we look at looking at closing costs, seller concessions, what are being paid out, when we look at where we are right now, there were 43% of sales, 43% paid seller concessions, paid closing costs to the buyer. Okay. And a lot of that has to do with the fact that as a buyer, you want to get closing costs even more than a lower price right now. You'd like to get both, right? But by getting those closing costs, like I said earlier, we did that scenario where just getting 2% in closing costs would save you $600 a month in a payment, take you your first year in a 2-1 buy down from 6.5% to 4.5%. Okay. In your second year, you'd be at 5.5%. But again, you can always refinance with no out-of-pocket cost, with no penalties or anything, after you've those rates drop in a few months or in a year. So guys, that 43% seller paid concessions, that paid, that's huge. That is huge. Typically that number is going to be about half that, historically. And the median concession paid being paid right now is $7,000. Okay. That's the median being paid. So, what I would say, I just want to share my screen with you here real quick and show you a few charts that we've got here. Let's see. Okay. Where am I here? If I can find it. Oops. Okay. Let me just get out of this and share my screen. Why is this not working? Okay, there we go. All right, guys. So again, when we look at let me just move this out of the way. Why this came up twice. Okay. So this is information from the NAR. Supply of homes is nothing like it was during the crash. You can see the graph down here, 2007, 2008, 2009, 2010, and so on, where we are on supply. Totally different than we were back then. Okay. And then, which I mentioned earlier, and then lending standards, totally different than they were back during the bubble. People have to jump through a lot of hoops before you just fogged a mirror and you could buy 3 houses. That isn't the case anymore. So we can see that that has been a big change. So again, this is why we're not in a crash situation like we were back then. Foreclosure starts then and now. You can see way up. Okay, even right straight through that whole period there, and we've just seen that decline. Okay, it's a little bit of an increase here, but nowhere. I mean, we're way off, and in the Phoenix area, it's like almost zilch. Okay, for the Phoenix area, these are national charts, because it's kind of a national idea what's going on here, why these are double clicking. Anyway, and the actual recession means falling mortgage rates always. So here's historically rates have fallen. In 1980s they fell 4.25, 81, 5%. Okay, because that's when they had the inflation going from Carter into the Reagan administration, and then Volcker came in, raised the rates, and then brought the rates back down. And then we have at 91, it was minus 2.25. 2001, you had almost a whole percentage point, well, a little bit over half. And then 2008, you had 1.13. We know where rates have been leading up to the pandemic. And then we had 1%. And guys, the longest we've gone, keep in mind the 2008 recession, that was caused by the housing market. And again, those poor lending practices. Okay. And the overbuilding and the over inventory. Okay. That's why it's actually good that the builders are like, okay, demand is slow, let's kind of slow our roll a little bit so we don't have all these all this stuff sitting out there. But at the same time, we've got this idea that we're actually under inventory. I know it's great, sounds nuts, but that's where we are nationally, that's where we are locally. And these factors, we can't ignore them. We also have to look at what that inventory really is. And again, a lot of it was investor type inventory, iBuyer type inventory, new homes coming on the market. And then when you kind of strip that away, you got a much lower percentage of overall homes just kind of sitting there. So guys, keep these things in mind. You can get lower rates right now with that 2-1 buy down, just refinance, in a year or whatever, when those rates come out. Get into the game now. Get a deal now, and then get the lower rate with the 2-1 buy down, and then get a fixed lower rate or an even lower rate refinancing later. That makes sense. So guys, if you have any questions, make sure you reach out to us. Again, you can always call, text us on our personal cell. And that would be, and this would be, to contact Cynthia or I at 480-788-8569. And that would also reach out to our entire team if for some reason we're not available. And then you can always email us at home@mincolagroup.com. Check us out at mincolahomes.com, mincolagroup.com, and make sure you like, share, and follow, subscribe to us on YouTube and Facebook and Instagram and Twitter and all that good stuff. You can even follow me on LinkedIn. So guys, if you have any questions, let me know. I'd love to be able to help you out with understanding what's going on in your market, what's going on, with your home prices right now, or if you're thinking about, should I wait to buy or sell? and look at that for you. And for some people, again, you may not be able to afford the payments right now, even with a 2-1 buy down, and that's fine. Just you got to do what you got to do. But if it makes sense, it makes sense to get that lower, maybe that lower price on a home right now if you can afford the payment. Work with that 2-1 buy down program, and then again refinance later on to a fixed rate. All right, guys. Hope to see you soon. And if you have any questions, feel free to reach out.